Use on-chain data to understand Bitcoin. Welcome to Mr. Big. You may think that when Bitcoin drops hard, it automatically becomes cheap. That is the trap. In a bear market, the most dangerous moment is not always the crash itself. Sometimes it is the quiet period after the crash, when price stops falling fast, but liquidity also dries up. Every bounce looks tempting. Every green candle feels like the bottom is in. But if the on-chain momentum is not expanding, that bounce may be a low liquidity fake move, not a real cycle restart. Here is the direct read. This does not look like a clean bull market restart. It also does not look like simple oversold relief. The chart points to a bear market liquidity compression phase. In plain English, price is moving, but the deeper on-chain energy is not strong enough yet. There are buyers, but not enough sustained new liquidity to carry the market into a broad expansion. That is the kind of environment where rallies can be sharp, but fragile. Realized hold ratio sounds technical, but the core idea is simple. It compares very young coins, roughly coins that moved within 1 week, with older coins that have been held for 1 to 2 years, then adjusts for Bitcoin's market age. Young coins often represent fresh activity, short-term money, and speculative heat. Older coins represent more seasoned capital. So Realized Hold asks, is new money rushing in, or is the market mostly being held up by older, quieter coins? Here is the calculation idea in plain English. Realized Hold Ratio looks at the realized value of very young coins, usually the 1-week age band, and compares it with the realized value of older coins, usually the 1 to 2 year age band. Then it adjusts that comparison for Bitcoin's age as a network. So it is not just asking whether price is up, it is asking whether fresh, recently active capital is becoming stronger compared with older holder capital. Think of a shopping mall. From the outside, people are walking around, lights are on, music is playing, and it looks active. But if very few people are actually paying at the register, the mall is busy without strong cash flow. That is how I read weak realized hold expansion. Price can bounce. Traders can get excited. But if the ratio and momentum do not confirm fresh demand, the market may be moving on thin liquidity rather than real cycle strength. The latest snapshot is the 27th of May, 2026. Bitcoin is around $75K. Realized hold ratio is near 0.09, and realized hold momentum is about 0.29. Focus on the blue-green momentum line. When realized hold momentum moves up, short-term capital inflow is getting stronger. In plain English, more USD-denominated wealth is shifting back toward new demand. When realized hold momentum moves down, short-term capital flow is weakening, and speculative heat is cooling. Right now, the chart does not show broad, fresh liquidity taking control. It looks more like a bear market low liquidity compression phase. I am watching 3 signals. First, price is not in a strong impulsive uptrend. It is still struggling after a larger decline. Second, realized hold ratio is not expanding like a hot bull market phase, which means fresh short-term liquidity is not clearly taking control. Third, realized hold momentum and its 90-day average are not showing a strong, synchronized recovery. Put those together, and the market looks squeezed. Not full panic, but not healthy expansion either. This is where retail traders often get caught. Price jumps 5%, 8%, maybe even 10%, and the brain immediately says, the bottom is in, I cannot miss this. But in a low liquidity compression phase, moves can be exaggerated because the order book is thin. A rally without confirmed on-chain momentum can turn into a relief bounce where trapped holders sell into strength. You think you are buying the bottom, but you may be providing exit liquidity. I would change this view only if 3 things improve together. First, the realized hold momentum 90-day average needs to stop falling and begin flattening or rising consistently. Second, the background regime needs to shift from cooling to warming, not just for 1 day, but with persistence. Third, price needs to confirm with stronger structure instead of getting rejected every time it bounces. Until then, the safer label is still compression, not full restart. So the short version is this. Realized hold ratio helps compare fresh activity with older coin weight. Realized hold momentum tells us whether short-term capital flow is strengthening or cooling. The 90-day average helps filter out noise, so we do not overreact to 1 candle or 1 daily move. Right now, the signal is not screaming maximum panic, but it is also not confirming a comfortable bull market restart. It looks like a bear market low liquidity compression phase, and that is exactly the kind of phase where patience matters more than chasing. This video is personal research based on public data only. It is not investment advice. Remember to like and subscribe. Thanks for watching, and I will see you next time.